We don't have the internet mania, we have the AI mania. So the stage is quite similar to the prior bubble in equities. We don't think that stocks are in a full-blown bubble quite just yet.
And then we're relying on sort of a machine learning technique known as imitation learning. So effectively seeing how humans drive and using that to learn.
First, large deployments will be in the US, Australia, Western Europe, Singapore, UAE, and China, of course. It will be difficult in developing countries due to the lack of infrastructure, but they will get there eventually, given the cars, they keep getting smarter and the infrastructure keeps improving.
It's not only the cost, which could be a third of the original cost, but it's also the efficiency that you can serve this all day, all night, ultimately. The Robotaxi doesn't need to sleep.
Markets, business, technology, investing, insights. AlphaTarget Pulse. AlphaTarget Pulse is a production of AlphaTarget Limited, a company registered in Jersey Channel Islands. The opinions expressed in this podcast and the information provided are for informational and educational purposes only and are not to be construed as investment advice. You should consult with your own registered investment advisor or other qualified financial professional before making any investment decisions.
Welcome back to AlphaTarget Pulse, your podcast for insights on markets, business, technology, and investing. Let's kick off this show by covering the news flow over the past couple of weeks. There's a lot going on in the business world, in the world of technology especially, and recently there were some significant announcements by companies which will likely reshape the business landscape for the foreseeable future. So first of all, OpenAI announced that it is introducing apps in ChatGPT and the new Apps SDK, integrating various products directly into ChatGPT, such as Figma, Canva, Expedia, Booking.com, and Spotify, etc. This obviously is a game changer for these companies and how consumers will basically integrate with these products going forward. So unsurprisingly, this caused a big rally in stocks for some of these companies. Thereafter, a few days later, OpenAI and Broadcom announced a strategic collaboration to deploy 10 gigawatts of OpenAI designed AI accelerators. So basically, we're just hearing, big, ginormous deals being announced and signed between OpenAI and other companies, obviously, which is good for AI, but we will have to see how this actually plays out because there's a big difference between empty promises and cash actually spent. Finally, Google announced Gemini Enterprise, a comprehensive AI platform designed to serve as the new front door for AI in the workplace. This subscription-based service aims to integrate company data, tools, and applications into a secure conversational interface powered by Google's advanced Gemini AI models. It'll go beyond individual task assistance by enabling entire workflow automation through pre-built AI agents, custom agent building, and an agent marketplace for third-party integrations. So Google was left for the dead a few months ago, but we've now recently seen that Google's search volumes have actually picked up significantly. And Google is now obviously making inroads into this space in AI. And the Google-powered AI search is also pretty useful. So as the old adage goes, you don't discount the incumbents very quickly. And companies with this sort of clout always do sort of find a way to fight back. So, the trophy is still up in the air. We'll see how it plays out. On the monetary policy front, Fed Chair Powell recently noted that QT is coming to an end soon. Balance sheet will stop shrinking, which is actually a big plus for risk assets. And he signaled also that more rate cuts are likely due to a softening labor market in the US. When it comes to investing, monetary policy trumps everything else. So this change in monetary policy, in our view, is actually positive for equities, especially long duration assets, growth stocks, which are extremely sensitive to changes in monetary conditions and in the discount rate. Finally, on the political front, Mr. Trump or President Trump recently announced that tariffs on China will increase to 100% in response to Beijing imposing strict export controls on rare earth minerals. This caused a sharp sell-off on Wall Street, followed by volatility in equities. And this has also caused some volatility in equities over the past few days, which is normal. People are basically booking profits. They are wondering what the future will hold. So this sort of zig and zag is completely normal, especially after the big run-up we've seen off the April lows. So what does this all mean? Well, we don't have a crystal ball, but we can make educated guesses based on monetary conditions, based on where we feel we are in the cycle. First and foremost, rate cuts and end of QT are a big tailwind for stocks, especially long duration growth stocks. We still feel that we are in a similar situation as the late 1998 cuts by the Fed, which triggered a huge rally in technology stocks in the following year amidst the internet mania. Today, we don't have the internet mania, we have the AI mania. So the stage is quite similar to the prior bubble in equities. We don't think that stocks are in a full-blown bubble quite just yet. We think that this is an incipient or a developing bubble. And if we do get rate cuts and the end of QT, then equities have a very strong likelihood of being significantly higher 12 months from now, especially tech stocks. So this is something to keep in mind. We have now just also entered the seasonally strong time of the year for stocks. Historically, Q4 has been very, very good for equities. So we expect the equity market to remain strong heading into the end of the year and perhaps early next year also. If the US economy holds up, it avoids a recession, then history suggests that basically it will be very good for equities. Just to give you some context, following the first rate cut after a 6-month pause, the S&P has historically rallied about 20% over the following year. So we've had a first rate cut after a 6-month pause not so long ago, and we are still in that golden period where equities generally tend to do well if the economy holds up, which seems to be the case given the strong earnings from the banks which were recently released. So given these factors, we think stocks, especially AI-related growth stocks, should deliver strong gains over the next 9 to 12 months. So with this out of the way, with the news flow in the stock market outlook covered, let's now bring in our team of analysts and discuss the topics for today, which is basically autonomous driving. Recently, the subject has been getting a lot of airwaves in the media with the progression of Waymo's Robotaxi service, the launch of Tesla's Robotaxi service in Austin, and key tests and partnerships between the ride-hailing networks like Uber, Grab, and Lyft, and Chinese companies which are developing autonomous driving technologies. So it's time to now say hello to our team. First and foremost, Irnest, our numbers man, CFA charter holder, top-ranked analyst in South Africa, and former analyst at Societe Generale. Anirban, Mr. Bleeding Edge, PhD in computer science and former director of research and portfolio manager at the Motley Fool in Australia. Damia, our data queen, former analyst who previously worked at Citibank and investment banks and brokers in Malaysia. And finally, Oyvind, our big picture guy, who previously worked at Peel Hunt, Berenberg, also as a family office, as an investor, and at MMC Ventures in private equity. So, guys, how are you all doing this morning?
Great.
Doing well.
Right, let's talk about the autonomous driving space. Obviously, there's a lot of noise around this, a lot of excitement, a lot of confusion. So hopefully we can give our viewers and our listeners some insights into how this space is likely to evolve over the next few years. So first of all, Anirban, I'll come to you. Why don't you give us a high-level overview of this space and tell us the different approaches being deployed by the key players?
Thanks, Puru. I love talking about this because I recently had a 17-year-old learn to drive, and I've got a Tesla with FSD supervised down under, again, recently available. So glad to talk about this. I think the best way to think about how autonomous technology is being developed is how actually we make new drivers, or how we teach a new driver. So the new driver goes out, first learns by looking at the rules, understanding sort of road etiquettes, then practices as a learner to apply the rules to sort of develop situational awareness, right? The autonomous tech is basically trying to do exactly that. It's trying to do that by developing sort of a mental model equivalent of the driving world using AI and sensors. Now, in sort of the AI world, at least, or the autonomous world, how this works is you sort of have a pipeline, and the pipeline involves perception, which is essentially using a range of sensors like, cameras or LiDARs or ultrasonics or radar, whatever, a combination or maybe one of them or whatever, to detect essentially lanes, objects, people walking and so on and so forth. That's sort of overlaid on a map data. The map data could be highly, defined. So a high def map, centimeter level accuracy, or just a simpler GPS level map, the one that we sort of see through Apple Maps or Google Maps. That then feeds into what's called a planning and control stack. So the planning really just decides, if you want to go from A to B, how do I get there? What are the sort of the turns and so on and so forth I need to make? And the control stack really decides sort of the action and how that translates into, the speed and the braking and so on and so forth. Now, it's important to sort of realize that the model is built and iterated on offline, and the inference sort of runs on the vehicle, right? Now, with that sort of high level view, we can abstract and sort of think of how the technology is being developed broadly, roughly in two different approaches. And, sort of the approach has been pioneered by sort of the behemoths. And I think, multiple different companies are now sort of, following one or the other. So we'll go with Tesla's approach first. So Tesla sort of uses the end-to-end vision-heavy approach. It uses a massive fleet. So it uses this fleet to build a neural network using camera feeds, right? And the camera could, deliver you video and audio. And then they're relying on sort of a machine learning technique known as imitation learning. So effectively seeing how humans drive and using that to learn. They're not using HD maps. And because they're sort of controlling the hardware and the software stack, they're basically rapidly iterating and trying to improve the model. So that's one approach. The other approach, which is sort of pioneered by Google and others like, Cruise, for example, used it. This is, effectively, I would describe this as a sensor fusion combined with high-def maps with geofencing. So here what you're doing is you're using multiple sensors for redundancy. You have a very highly defined map, which gives you very granular information, and you combine that to sort of drive in a limited geofenced area. And right now we know that Waymo's approach allows them to deliver commercial robotaxi operations in different geographies. San Francisco. They're going to apparently, they're soon going to launch in London and so on and so forth. So I think those are sort of the two different ways to do autonomous driving.
Right. So, given what you just described, in your opinion, which approach is better and why? Can you just share, the pluses and the minuses of both approaches?
Yeah, so I'll try to, it's difficult to give an answer here when the field is evolving. So I'll try to be a little bit nuanced here. So in the shorter term, I think what we know for sure is the sensor fusion approach, which is the HD maps with geofencing, is better. Better in the sense that it is the faster road to commercial robotaxi operations, as Waymo has demonstrated. And for example, Apollo Go is doing in, say, China, right? In the medium to long term, though, I believe that the Tesla's approach has numerous advantages. And the advantages here are, the billions of real world and shadow miles essentially allowed them to capture sort of the long tail of various scenarios. That's a data advantage, which you then couple with the ability to sort of iterate and learn how humans drive using this imitation learning approach. So it turns essentially the autonomy problem into a computational challenge. And it's a computational challenge at two fronts. It's a computational challenge at the training level. It's a computational challenge at the inference level. However, I would still say, as I just started by saying, I think the jury is still out, and the jury is out in the sense that, we don't actually know with any certainty, I guess, which one is going to land up winning, or maybe both win, right? And I think what I would say here is a couple of things to watch. As I said, I've got this, FSD supervised down under available. That basically shows that you can take a US based version and translate it into a right-hand side drive model, and actually kind of works, right? So that's an example of scaling. Yet I think if you compare the different approaches, what I would say is important here. If one believes that this end-to-end approach is going to work, then one would have to see how Tesla's operations, for example, scale at Austin. For example, when do they remove the safety observer? How are they able to enter other markets, and so on? So I think, as they usually say, the proof is in the pudding. So we'll wait for the pudding to be built.
Fair enough. So, why don't you tell us how this technology can be commercialized. Like, having the hype about autonomous driving is one thing, but as investors, what matters is profits and free cash flow. So can you share your thoughts on how this technology will be deployed by the different players? What might be the different revenue streams?
Yeah, so I think we are already seeing deployment of robotaxis, right? So robotaxis are in commercial operation as far as Waymo is concerned. There are a few others around the world that have commercial robotaxi operations. So there is commercial robotaxi operation that is definitely possible. The other line, I think, which is also evolving is you can think of these solutions and ADAS solution or advanced ADAS solutions leading to full autonomy. Those solutions then could be on passenger vehicles or, for people to use, consumers to use, or for people to, for example, add their vehicles to a fleet. That's one, so those are two different options. The third option obviously is licensing the software or the hardware and the suite to an OEM or a fleet operator, whoever wants to, deploy robotaxis at scale. So I think there are a few different avenues. And I think, again, this is an evolving field right now. I think the most widely deployed solution is a commercial robotaxi deployment.
So now let's move over to Oyvind. Thanks, Anirban, and get his take on the autonomous driving space. So Oyvind, when do you think this technology will roll out at scale? What do you think are the hurdles?
Yeah, so it's going to take quite a while, quite a few years for this technology to scale. If you look at kind of the leaders, Waymo and Apollo Go, they each have just over 1,000 cars on the road right now. And even when you look at their expansions with partners, it's usually only in the low thousands of cars. That's, tiny compared to the global fleet of over 1 billion vehicles. And the reason for that is that there's plenty of hurdles standing in the way of scaling. So you have insurance, you have safety validation, you have regulatory approvals, just to name a few. So every time autonomous players enter a new market, they can't just flip a switch and deploy 1,000 cars. They need to get approval, run local tests, learn about the roads, work with regulators. So right now, Waymo is currently entering into Japan, and they will initially be having people manually driving these Waymos so that the Waymos can learn the landscape. So it's a phased approach. The only company really talking about scaling into the millions right now is Tesla, with its upcoming Cybercab expected to go into mass production in 2026. But even Tesla will have to navigate many of these same challenges, so it will take a long time to scale.
And, autonomous driving only appears to be, several years away, or at least, visible in the developed world. But given the state of traffic and infrastructure, it is not likely to gain traction in the developing countries, especially in Africa and Asia, South America, and so forth. What is your view on this?
Yeah, first, large deployments will be in the US, Australia, Western Europe, Singapore, UAE, and China, of course. It will be difficult in developing countries due to the lack of infrastructure, where traffic is chaotic and not everyone's really following the rules. So I think it will take over 10 years before developing nations start seeing traction. But they will get there eventually, given the cars, they keep getting smarter and the infrastructure keeps improving.
Fair enough. And of late, there's been a lot of talk that autonomous driving and robotaxi fleets will kill the ride-hailing companies, but we've recently seen announcements from Uber, Grab, and Lyft, which indicate that robotaxi fleet operators will in fact deploy their vehicles on the ride-hailing networks because that's where the demand exists. And it will be very hard for the new players to create a two-sided marketplace from scratch. What's your view and thoughts on this?
Yeah, so we did see Waymo taking significant share from Uber and Lyft in San Francisco, but overall, most autonomous players are still testing different business models, and they don't actually want to be in the ride-hailing business themselves, especially the Chinese players, because acquiring users is very, very expensive. So from their perspective, partnering with ride-hailing apps is the fastest way to market, so there's a natural synergy there. I think the big wild card, however, in all of this is Tesla, as it's a bit unclear what their partnership strategy will look like. So, if Cybercab is extremely successful and Tesla doesn't want to partner, that could pose a risk to some of the ride-hailing services in the long run. I think looking at different services, I think Lyft is most at risk given its heavy NA exposure. There would also be some risk to Uber, but they're a bit more geographically diversified. And Grab would be the least impacted given its Southeast Asian focus.
Oh, fair enough. Ernest, you've been listening to this discussion patiently. Can you give us your thoughts on the viability of the robotaxi fleets? What makes you sure that they will eventually replace human taxis in most parts of the world?
Thanks, Puru. Yeah, this is a very, very big and important area. And what I want to highlight here is work that I've looked at. If you analyze what the cost is to run a taxi over 5 years, the cost of the car, the petrol, the assumed kind of mileage that you do, you will find that the human driver over a 5-year period will normally be about 60 to 70% of the total cost. And you can kind of take all that info and distill it into a cost per mile. That's a very important thing. So if you look at the 60 to 70% cost, if we can take that out with autonomous driving, we really can unlock a lot of value. So I'm positive that the players in this market are going to push as hard as they can to make this a reality.
I mean, that makes sense. If one taxi is significantly cheaper than the other, then there is no incentive whatsoever for people to opt for the more expensive option. Most people try and save money. So if the driver is removed and the autonomous cost per mile is significantly less than the human-driven taxi, then over time, like any other technology, this technology will scale.
Sorry, just to interject there, you're right. It's not only the cost, which could be a third of the original cost, but it's also the efficiency that you can serve this all day, all night, ultimately, if there's demand for it. People, the Robotaxi doesn't need to sleep.
No, that is true. Can you also share your thoughts on the economics of the business, Ernest? What are the operating metrics investors ought to keep in mind when evaluating investment opportunities in this space? Do you think it will be a winner-takes-all market, or do you think there will be a key few players in each region?
Yeah, thank you, Puru. I think that this has got really good economics if you're a company that's not investing in the actual cars. So if you're a low capex type of operation and you're focusing on the autonomous aspects of it, you'll have high margins, low capex. It's a pay-as-you-go type model, so there's not that intensity on working capital. And I think you've got to look at the growth, and you also you've got to look at the margin sort of profile of the company and the free cash flows. As far as whether this is going to be a winner-take-all or most kind of situation, I don't see it that way. And the reason is there's so many different geographies. And as Oyvind and pointed out in his previous comment, every market's got its own regulatory perspective. And I just cannot see one player dominating the globe on this front. I think there's going to be multiple geographies, but there's also going to be pure play operators and then those that team up with the ride hailers like the Ubers of the world. So I think it's going to be quite a complicated industry with a lot of players, and it's huge enough, I think, to support many.
Yeah, I tend to agree with you. I don't think this is a winner-takes-all market. As you mentioned, there are different players in different countries. I don't think the governments of the world will allow one company to monopolize the world's transportation system. I may be wrong, but I just don't see it happening. Thanks, Ernest. Finally, let's bring in Damia to get her view. Damia, investors who are currently considering this space have got options like Ernest mentioned. They can gain exposure via Waymo, which is majority owned by Alphabet, or through Tesla, which is a vertically integrated player. But these are not pure play bets on autonomy because they have huge legacy businesses. These companies' revenue base is also significant. For our part, as our subscribers know, we've gained exposure to this space by investing in pure play ADAS and autonomous driving technology providers, which are much smaller companies. And should they succeed, their revenue growth will be exponential over the next several years. So can you basically give us your thoughts on this and share some numbers and how much revenue Alphabet and Tesla generated in 23, 24 and the first half of this year? And what is the consensus for these companies for this year and next year and the year after? And what are the growth rates like, so people can get an idea of what sort of growth is baked into the consensus estimates for these ginormous companies?
Yeah, definitely, Puru. I'll start with Alphabet first. Alphabet generated revenues of 307 billion and 350 billion in 2023 and 2024 respectively, with 189 billion in the first half of 2025. Consensus expects Alphabet to deliver between 395 to 490 billion in 2025 to 2027, which translates to an annual revenue growth rate of between 11 to 13%. If we look at Tesla, the company delivered revenues of 97 billion and 98 billion in the past 2 years, while in H1 of 2025, revenue was around $42 billion. Consensus expects a slight decline in revenue of negative 2% year-on-year in 2025 at $95 billion, but going into 2026 and 2027, consensus is forecasting double-digit revenue growth at 16 and 20% year-on-year, reaching about $110 billion and $129 billion respectively. From these numbers, we can see it's very hard for these companies to deliver massive revenue growth coming off a high base in the past couple of years. Revenue contributions from the AV business may not be material enough to drive hyper-growth revenue for these companies in the future, Puru.
Yeah, I mean, that's what is concerning. If you want exposure to this space and capture all the upside, then pure play companies in this space offer much more compelling opportunity, in my view anyway, than investing in these big companies, which may also ultimately turn out to be good investments, but investors may not actually capture the hyper growth, which typically drives stocks a lot higher over the first few years. Can you also tell us what is the gross margin and free cash flow margin of Alphabet and Tesla done?
Sure. As you mentioned earlier, Puru, while Alphabet is the majority owner of Waymo, it mainly operates in other IT businesses. Alphabet has stable gross margins of around 60% every year. The free cash flow margins are in the teens to low 20s%, mainly affected by the amount of capex spent on building AI infrastructure. So any growth acceleration in Waymo's business will not really move the needle for Alphabet. In the case of Tesla, it has low margins but high capex. Tesla's gross margin are usually below 20%, while its free cash flow margins are typically less than 5%. It's also affected by the cyclicality of the legacy auto business with tough competition from China. Therefore, we may continue to see pressures in its margins. Comparing this with a pure play ADAS player that we are invested in, the company has around 70% gross margin with free cash flow margins of roughly 14 to 20%. So it is already a high margin business, and it will definitely benefit greatly from a growing demand for autonomous vehicles.
Fair enough. And what do you think about the valuation in this space? When you look at the valuation for a company based on the next 12 months PE ratio and our DCF model based on consensus estimates, can you give us some idea of that as well?
Yeah, of course. So both Alphabet and Tesla are trading at high valuations at the moment. Alphabet has a next 12-month PE of 25 times, which is marginally above its 5-year historical mean of 23 times. Tesla is trading at a staggering PE of 209 times, which is much higher than its 5-year historical mean of 97 times. Based on our DCF model, assuming a 3% terminal growth rate and 9.5% discount rate, Alphabet has a fair value of around $209 per share. This has at current level, this has a downside of around 17% from the latest share price. We have Tesla's fair value at around $223 per share, which according to the latest price could raise a 49% downside. As you know, Puru, we have invested in a pure play AV company, and based on our DCF model with consensus estimates, this company has a potential upside of over 100% from the latest share price. Therefore, we are definitely well positioned to directly capture the growth of autonomous vehicles.
I mean, that makes sense. Tesla's multiple is high because there is a lot of excitement built in, and you have a legendary, iconic CEO, and you also have some of the premium built in because of the robotics business. So, it is always, you have to be careful when you look at the valuation of any given company in isolation. But the point that we just want to put across is that, if you do invest in the autonomous space via Tesla or Google, you have to contend with the legacy businesses, which are already huge. So, they're not pure play companies. In the case of Tesla, you've got the auto OEM business, you've got the energy business, you've got the robotics business, and then you have the FSD business. For Google, you've got the advertising business. The search business is under attack from LLMs and, AI. Although Google is doing a good job, finally, to actually, ward off the competitors. And they also have a cloud business. So if you're looking for a pure play way to invest in this space, unfortunately, both Alphabet and Tesla are not the way to do it. Well, this brings us to the end of today's show, and we hope you enjoyed the discussion. Before we leave, we just want to mention that AlphaTarget publishes deep research on disruptive high-growth companies in the public markets. We invest in the same businesses ourselves, so we eat our own cooking. Since inception in June 2024, our portfolio has appreciated by almost 60% versus a 24% gain in the S&P 500 index. If you'd like to learn more about our paid research subscription service, please visit alphatarget.com. Thank you very much, and see you again in a couple of weeks. Thanks, guys.
Thank you for tuning in to AlphaTarget Pulse. We publish deep research on disruptive, rapidly growing companies we invest in. Our subscribers gain exclusive access to our entire portfolio, including exact portfolio allocations, in-depth research, coverage of companies' news flow, and our earnings breakdowns, trading alerts of our portfolio moves, and our proprietary hedging indicators. You can find subscription information at alphatarget.com. We'd love to have you join us there.